Welcome in PharmD Nation. I know a lot of you already know this, but one of the most common type of accounts that people open that they anticipate using for their longer term healthcare expenses is a health savings account, usually known as an HSA. And a lot of people have the opportunity, if you're in the right type of healthcare plan, to open up, fund, and use an HSA. And it's a great account because it offers the type of tax advantages that not many other type of accounts are able to offer, which is the primary reason why people end out opening and using HSAs when it comes to paying for their medical expenses. But I'm here to tell you today you may want to rethink how you're using your HSA, where most of the time people use those funds as they incur those qualified medical expenses, but they don't understand or know that you can actually reimburse yourself at a later date for those medical expenses if you wanted to, giving those funds more time to grow and compound in the investment account that you have set up for your HSA. For example, again, we covered what is an HSA. It's a health savings account. It's obviously used to pay for qualified medical expenses. And as long as those expenses are incurred after the HSA was opened, you have the ability to reimburse yourself for those qualified medical expenses. So if you have a medical expense in 2022 and you keep good books and records, you can actually reimburse yourself for those expenses years later by pulling out money from your HSA and just depositing into your checking or savings account. There is no time limit to reimburse yourself. So it could be a couple years later, it could be 5 years later, it could be 20 years later that you decide to pull money out of your HSA to reimburse yourself for those qualified medical expenses that you paid out of pocket earlier in life. So why is this such a big deal? Well, let's just assume that on average you have qualified medical expenses of about $2,500 a year. Let's also assume that you're making a $6,000 contribution into your HSA. Let's assume that of that $6,000 that gets contributed into your HSA, you can get an 8% rate of return on your money. And there are two different scenarios we're going to look at. Let's just say that the first scenario is you pay through your HSA those medical expenses every single year. And then the other scenario is, let's assume that you pay out of pocket for those expenses in the year and then reimburse yourself later on. Well, for the first 3 years of money going into the HSA and coming out of the HSA, at the end of 3 years, you're going to have about $11,362 in this scenario. But if you paid out of pocket, that $6,000 contribution over the course of 3 years grows and compounds on itself, where at the end of 3 years, you have about $19,478. And if you use the $7,500 you paid out of pocket to reimburse yourself, that would leave you with an ending balance of $11,978, which is a little over $600 more in your HSA at the end of 3 years than if you would have just paid as you went out of your HSA. Same scenario, but over the course of 5 years, you have almost $2,500 more sitting in your HSA if you pay out of pocket and then reimburse yourself at the end of 5 years. And if you wait until 10 years to reimburse yourself, you're looking at almost $12,000 more in your HSA at the end if you would just pay out of pocket and reimburse yourself at the end compared to paying out of your HSA as you go. Now, it's important to note that a lot of HSAs are set up at places like bank accounts where you're not going to earn anywhere near 8% rate of return. So that's something you're going to want to look into, is finding an HSA account that will allow you to invest the money in more robust investment type of investments inside accounts that allow for that. Just like your 401k or taxable investment account, investments like that. Finally, the last thing you're going to want to be aware of is you need to document all those medical expenses. If you're going to pay out of pocket and then come back and reimburse yourself at a later date, chances are you're going to have to prove that those medical expenses were actually incurred. And being able to store your receipts and document that in a place like Dropbox or Google or another file sharing or storing software is going to be incredibly important. Because at the end of the day, the IRS will want detailed proof of those medical expenses you paid out of pocket earlier in life if you reimburse yourself, if you get to a point where you incur an IRS audit. So there you go, PharmD Nation. If you have an HSA and you're continuously taking money out of your HSA to pay for your medical expenses, that's great. But if you can afford to pay out of pocket first and let those HSA dollars grow and compound on themselves, and then use that money to reimburse yourself later on down the road, you could end out having more money in your HSA than you otherwise would. So just keep that in mind. Until next time, PharmD Nation, happy planning.